Something just crossed my desk that signaled an emergency. There is a mathematical fracture in the global financial system, so I need you to put the champagne down for a few minutes. I need you to step away from the noise, and I need you to look at hard data from the other side of the world, because the Chinese silver market just screamed a warning that is impossible to ignore. This is not a chart pattern. This is not a prediction. This is not a maybe. I want you to look at the number I'm about to put on the screen. $80.53 per ounce. This is not a typo. This is not clickbait. This is not a thumbnail trick. This is a verified physical silver price in Shanghai right now. Specifically, the Shanghai Futures Exchange front month contract, SHFE A2601, which settled at 18,145 yuan per kilogram before the holiday break. Now, look at your brokerage app in the United States, $71.80. Do you see the problem? That is a $9 plus difference per ounce. In professional markets, we don't call that a spread. We call that a broken market. Let's do the math together. Step 1, Shanghai price, 18,145 yuan per kilogram. Step 2, convert to USD using the current exchange rate 18,145 divided by 7.006 equals $2,589.92 per kilogram. Step 3, convert kilogram to troy ounces, 32.15 ounces per kilo, $2,589.92 divided by 32.15 equals $80.55 per ounce. The math is undeniable. The largest manufacturing economy on earth, the country that actually uses silver, is valuing it at $80 plus. New York is pretending it's $71. Why this should terrify the banks. In a healthy global market, this gap cannot exist. If silver were really cheaper in New York, every bank, hedge fund, and algorithm on the planet would buy silver in New York, ship it to Shanghai, sell it instantly for risk-free profit. That's called arbitrage. It's a force of gravity in global markets. Normally, the gap is cents, maybe $1 in extreme volatility, not $9. When arbitrage stops working, gravity has turned off, and there is only one explanation. The metal cannot move. Either the silver in New York doesn't exist, or the logistics chain has collapsed under Eastern demand. The paper price and the physical price have officially divorced. Ghost Week, the perfect storm. Tomorrow morning, U.S. markets reopen for Ghost Week. Low volume, illiquid trading, skeleton crews, and sitting beneath the surface is a $9 vacuum pulling prices higher towards Shanghai. Nature abhors a vacuum. China will not lower its price because China has a shortage. That means New York must rise. We are staring directly at the risk of a violent gap up when the algorithms wake up. This is not speculation, this is industry. Here's what most people get wrong. This is not a retail frenzy. This is not a hedge fund trade. This is not GameStop or crypto. The buying in Shanghai is coming from commercial hedgers, factories. The whale in this market is not a bank. It is the factory floor. And an industrial run is far more dangerous than a financial run. If a bank doesn't get cash, it survives. If a factory doesn't get silver, it shuts down. That's why they're paying $80. Solar. The thrifting lie just died. China controls over 80% of global solar manufacturing. For years we were told, don't worry, they'll thrift silver away. That narrative just died. According to the China Photovoltaic Industry Association, silver usage per watt has stopped falling. They hit the wall, and now the industry is shifting to TOPCon and HJT cells, which require 50 to 80% more silver than older technology. At the exact moment mine supply is flat, solar demand just structurally increased. Factories in Jiangsu are now taking delivery directly from the exchange. They are melting investment-grade bars into industrial paste. That is desperation. The EV shock no one is pricing in. Now, we talk about the real accelerant, solid-state batteries. Reports this week confirm progress toward mass production. And the anode is not graphite. It is silver carbon composite. A normal EV uses 20 to 50 grams of silver. A solid-state EV can use up to 1 kilogram. That is a 20 to 50 times increase per vehicle. China is the world's largest EV producer. They are not waiting. They are strategic hoarding. They are buying silver like lithium in 2021, locking supply before competitors can. The inventory collapse. Shanghai warehouse stocks. 2021, over 3,000 tons. Today, under 800 tons, a 75% drawdown. Registered inventory, metal available right now, is nearly gone. That's why China is in backwardation. They're paying more for metal today than for metal tomorrow. The market is screaming, "Don't promise me silver, give it to me now." Why arbitrage is failing? If this were free money, Wall Street would take it. So why hasn't the gap closed? Because the metal isn't showing up. Vaults need time to locate bars. Refineries are booked for 6 weeks. That phrase, locate the bar, is a red flag. It means the silver is not where it's supposed to be. The smoking gun, COMEX drain, December 23rd, COMEX report, Asahi Vault, minus 1.4 million ounces registered, JP Morgan, minus 600,000 ounces, CNT Vault, minus 200,000 ounces in 1 day. Registered silver is the exchange's lifeblood. This is a bank run, and the buyers are taking possession. That metal is gone. London may be the final domino. Unverified, but credible reports suggest LBMA allocation delays stretching into weeks. London is the vault of last resort. If London is out of metal, the game is over. COMEX becomes a paper island trading ghosts. Tomorrow morning, how the squeeze happens. Skeleton crews, empty order books, algorithms on autopilot. A single industrial buy order hits the market. No sellers, price doesn't tick, it gaps. $72, $75, $78 in minutes. Options gamma kicks in. Banks are forced to buy futures to hedge losses. Buying pushes price higher. Higher price forces more buying. Feedback loop, no inventory to stop it. $80 is not the top, it's the floor. When New York matches Shanghai, the suppression mechanism breaks. Banks cannot cap the price without losing physical metal. That means true price discovery. To balance supply, demand must be destroyed, impossible. Or supply must be created, takes 10 years. That means price does the work. $80 is the wake-up call. $125 to $150 is equilibrium. How not to get shaken out. Your biggest enemy is your brain. You're anchored to $30 and $50. Stop looking at dollars. Look at the gold-silver ratio. Until silver is near 15 to 1, it is undervalued. Ignore flash crashes. Paper drops do not equal physical availability. If you can't buy metal at the screen price is fake. Final warning. There is a real risk the buy button disappears in early 2026. Out of stock, pre-orders only, weeks of delay. When that happens, spot price becomes meaningless. Secure ounces while they exist. This is the end of an era. This is not just about profit. This is the end of 50 years of paper control. The East has called the bluff. They are draining the vaults. They are demanding reality. The silver price is no longer set in New York. It is set on the loading docks of Shanghai. $71 is a lie. $80 is the truth. And the lie is about to be violently corrected.